All right, today we are diving deep into the future of law, a landscape that's being completely redrawn by artificial intelligence. Now, for any investor out there, getting a handle on this revolution is absolutely crucial if you want to spot the next big wave of opportunity. So let's break down where the smart money is really heading in the world of legal AI. So first things first, let's just talk about the sheer scale of what we're dealing with. The global legal services market. It's a $1.1 trillion industry, a massive number. But the real story here isn't just the size. It's the fundamental shift happening inside of it. The value that has traditionally flowed to law firm partners is now being captured by software companies. AI is the engine driving this massive wealth transfer. And for us as investors, that's where the story really begins. And this slide, this gets right to the heart of the technological leap that's fueling everything. We've moved beyond what we call generative AI, which is kind of like a co-pilot, a very sophisticated assistant, to agentic AI, which functions a lot more like a junior associate. Think about it. It's the difference between helping with one single task versus autonomously handling an entire workflow. For an investor, this distinction is everything. You're no longer valuing a tool that just replaces a monthly subscription. You're valuing a platform that replaces six-figure salary. And that is exactly why the market potential has just exploded. So here's our game plan for mapping out this new territory. First, we're going to get the big picture, macro view of this new industrial revolution in law. Then, we'll dive headfirst into the super competitive B2B landscape in the emerging high-stakes consumer market. We'll also take a look at Australia as a fascinating case study for where this is all going. And then, to wrap it all up, we'll give you a really practical investment framework to help you navigate the space like a pro. So, what's really driving this whole revolution? Well, it boils down to simple economics. Law firms are getting squeezed between clients who are demanding lower fees and the absolutely soaring costs of talent and technology. In this kind of environment, adopting AI isn't just about being innovative anymore. It's about pure survival.
And this right here, this is the core economic shift in a nutshell. Every single dollar a law firm saves by using an AI agent instead of a human associate is a dollar of service revenue that now flows directly to a software company. As an investor, this is the fundamental thesis. You are looking to back the companies on the receiving end of this historic transfer of value. It's as simple as that.
Okay, so let's switch gears to the B2B sector, because this is where the transformation is happening the fastest. The era of niche, single-purpose apps, it's pretty much over. Law firms are just tired of managing dozens of different tools, and now they're demanding integrated solutions. This has kicked off a massive consolidation around major platforms. And for startups, the message is crystal clear. Join a platform ecosystem or risk becoming totally obsolete. And you can see it right here in the money flow. The investment trends totally confirm this consolidation. We're seeing these huge, eye-popping valuations for platform players like Harvey and Logora, while Clio has become the essential operating system for smaller firms. So why is this happening? Well, because platforms create this incredibly sticky ecosystem with powerful data advantages and network effects that makes them incredibly difficult for new competitors to disrupt. The smart money is for sure backing these integrated solutions. But here's a crucial twist in the story. It isn't just the law firms driving this change. Their own corporate clients are feeling immense pressure to cut costs. And as a result, in-house legal departments are now starting to bypass their traditional law firms and buy AI tools directly from the vendors themselves. This is forcing the entire industry to adopt even faster than it wanted to. Now, for investors, this creates a really complex landscape. I mean, the opportunities are clear, right? You can serve that missing middle of mid-sized firms, you can build tools that enable new value-based billing models, or you can go big and automate entire workflows. But the risks are just as significant. The Microsoft risk is always looming. The billable hour itself creates this natural resistance to efficiency. And of course, the potential liability from a single AI error or hallucination is a massive concern. And this brings us to what might be the single most important due diligence question you can ask any B2B legal tech company in 2026. If Microsoft Copilot adds a good enough version of your product for free as part of Office 365, do you still have a viable business? The answer to that question separates the truly durable companies from the temporary features. Okay, so while the B2B space is all about consolidation, the consumer market is a whole different beast. Historically, it's been a really tough nut to crack for startups, but it also represents this huge, underserved population that just can't afford traditional legal help. AI is finally changing the economics, creating a genuine high-risk, high-reward opportunity for investors. The whole approach to consumer legal tech has really evolved. Early models were super confrontational, which pretty predictably led to regulatory crackdowns. The successful model today is way more collaborative. These mediator bots are focused on actually resolving disputes rather than escalating them, which is a much more sustainable and regulator-friendly business model that actually helps consumers. But an even more disruptive model is starting to gain traction, something called litigation mining. Now, with this, AI agents aren't just waiting for a client to show up. They are actively scanning the web for signals of corporate wrongdoing to generate cases from scratch. This totally transforms a potential legal claim from a one-off service into a searchable, monetizable asset that can be packaged and maybe even treated. It's opening up an entirely new market. So, where are these new aggressive business models actually being tested? Well, all eyes are on Australia. While the US and the UK might have the capital, Australia's flexible regulations have created this unique sandbox for legal tech innovation. It's giving us a real, live glimpse into the future of the entire industry. The key difference? It all comes down to a legal structure that allows non-lawyers to own law firms. This is a complete game changer. It means a single tech company can employ both software engineers and lawyers under one roof, creating this powerful synergy that just accelerates product development. And for venture capitalists, it means they can invest in one vertically integrated company, which is a much cleaner and way more attractive proposition. And this hybrid 95/5 model is the direct result of that unique structure. AI handles the vast majority of the work. We're talking research, drafting, all the admin, with a human lawyer providing that absolutely critical final review and sign-off. This approach gives you the efficiency and margins of a software company, but with the trust and compliance of a traditional law firm. It is the economic sweet spot for legal tech. So this has fostered a really vibrant ecosystem of companies worth watching. But what's especially interesting for investors are these sovereign copilots. These are AI tools trained specifically on local Australian law and data. These companies are building a powerful competitive moat that's incredibly difficult for the global giants to replicate, and that makes them prime investment targets. Okay, so with this entire map of the landscape, how can you, as an investor, actually identify the winners? In this final section, we're going to build a really practical framework for evaluating legal tech companies and finding those best opportunities, the real alpha. We've boiled it down to 4 key pillars for a strong investment. First, you want to back companies that sell outcomes, not just software licenses. This aligns their success directly with their clients. Second, don't overlook the boring but essential back-office infrastructure. It's often more profitable and defensible. Third, you have to demand capital efficiency. And finally, prioritize companies with deep technical integrations into their clients' core systems, because that right there is the new competitive moat. Let's just double-click on that capital efficiency point for a second. The key metric you need to know here is the burn multiple. It measures how much cash a company is burning to acquire $1 of new annual recurring revenue. Now, because legal tech has such long sales cycles, we're talking up to 18 months sometimes, a company can't just afford to buy growth at any cost. A burn multiple below 1.5 is a sign of a healthy, sustainable business in this specific sector. It's a critical number. Finally, here's your practical, no-nonsense due diligence checklist. You have to scrutinize their data rights. You need to understand their safety net for AI errors. Look really closely at customer churn to see if they're actually retaining their most valuable clients. And always ask if they can withstand the competition from big tech. Answering these tough questions will help you separate the real durable businesses from all the... This quote just perfectly captures the scale of the opportunity here. The legal profession isn't going away. It's being fundamentally rebuilt on a new technological foundation. The companies that are building that new platform are the ones who will define the future of law and, frankly, capture enormous value for their investors. And that brings us to the final forward-looking question. We are absolutely heading towards a future where law firms will build their clients for the work of an AI associate, a synthetic entity that works 24/7, never sleeps, never makes a mistake. So the ultimate investment question is this: who will own those synthetic associates, and who will be the ones to capture all of that value?